Why is a home's appraised value crucial for LTV? Imagine you're about to buy a house or get a loan to invest in one. You might wonder how lenders decide how much they are willing to lend. Well, a big part of that decision depends on what they think the house is worth today. That's where the home's appraised value comes into play. It's a professional estimate of what the property is worth in the current market. This value is determined by a licensed appraiser who looks at the home's condition, location, size, and recent sales of similar properties nearby. Now, the appraised value is used to calculate the loan-to-value ratio, or LTV. The LTV is simply the amount of money you want to borrow divided by the appraised value of the home, expressed as a percentage. For example, if the house is worth $100,000 and you want to borrow $150,000, your LTV is 75%. This percentage is very important because it shows how much of the home's value is being financed through the loan. Lenders see the appraised value as a safety measure. If the appraised value is high, it means the house is worth more and the lender's risk is lower. They are more comfortable lending larger amounts because the house can serve as good collateral. If the appraised value is low, the LTV goes up. That means the lender is financing a bigger part of the home's worth, which is riskier. If the borrower defaults, the lender might not get back the full loan amount if the house sells for less than expected. For real estate investors, this appraisal value affects whether they get approved for a loan and on what terms. Usually, lenders prefer an LTV of 80% or less. If the appraisal is lower than expected, the LTV might go above that, leading to higher interest rates or the need for private mortgage insurance. This insurance protects the lender if the borrower cannot pay back the loan. The appraised value also impacts how much equity the investor has in the property. More equity means the investor owns a larger part of the house outright, which reduces risk. When refinancing or taking out a home equity line of credit, the appraised value sets the maximum amount you can borrow. A higher appraisal can unlock more cash for future investments or improvements. Additionally, knowing the true market value from an appraisal can help investors negotiate better purchase prices or loan terms. If the appraisal shows the house is worth more than the seller's asking price, it gives the buyer more leverage. Conversely, if the appraisal is lower, it might be a sign to negotiate a better deal or walk away. In the end, the appraised value is the foundation for calculating the loan-to-value ratio. It influences how much money can be borrowed, the interest rates, the risk level for lenders, and the investor's financial position. Without an accurate appraisal, both lenders and investors would be flying blind, making it a vital step in real estate finance and investment.